Inflation climbs to a 41-year high with a year-over-year inflation rate of 9.1% for the month of June 2022. What does this mean for the markets? What does this mean for what the Fed is going to do? What does this mean for your portfolios? And how do you leverage trading something like this? As we said in the previous couple of videos, July is gearing up to be the most important month so far for 2022 because we have the inflation data, which came out today. We have the GDP numbers for Q2, which would tell us if we're officially in a recession. And we also have the last FOMC meeting before September. Are they going to go for a jumbo rate hike or not? We're going to get into all of this today. If this is the first time on the channel, welcome to The Traveling Trader. You get anything out of this, hit that thumbs up, and let's get right into it. All right, so as discussed, the US inflation hit a 41-year high at 9.1% year over year. The projections were set at 8.8%, and if you remember from last month, we came in at 8.6%. We were already getting reports and projections before the CPI that inflation was going to come in piping hot, everywhere ranging from the White House itself to economists, analysts on TV, etc. But I think the fact that it was over 9% was a surprise to everybody. However, if you think about it, just because the price of commodities dropped, that does not mean that oil companies and retailers were also dropping their prices. The price of gas remained high, the price of food remained high. And remember, the CPI measures what consumers are paying at the pump and at the register, not really the price of commodities dropping or rising. Throw in the fact that rent is still increasing month after month, and rent is a part of the CPI as well. Now, in order to brace for this type of volatility, we did buy calls on the VIX, expecting the VIX to spike if there was a surprise in the inflation report. CPI did come in hotter than expected, and those VIX calls spiked at the open. However, because the indices already tanked pre-market, it made it nearly impossible to send out pre-market day trade levels, so I did not take any breakout trades today. However, as a side note, we did launch the day trading course today, which will teach you how to day trade specifically using options, teach you how to read the day trade watch list, how to find levels, which strikes to pick, which expirations to pick, etc. You also get access to the Zoom calls with me. You get access to the alerts, the chats, etc. Sign up link is in the description below if you are interested. So was the CPI report all negative? Well, actually, there were a couple of silver linings. One of them is the core rate of inflation. So the core rate of inflation removes the element of food and energy. The thinking there is that food and energy prices rise and fall in an extremely volatile manner, and they don't really stay up for a very long time usually. However, this is a very sustained period of high energy and food prices. So the core rate of inflation is dropping. It went from 6.5% in March to 6% in May, and now we are at 5.9%. But the price instability issue still remains for most families because food and energy costs are non-negotiable. Those are things that Americans need to spend on. Food prices climbed 1% last month, but grocery prices have climbed 12.2% in the past year, the sharpest rise since 1979. And rents have increased almost 6% in the last 12 months, which is the highest in 36 years. So after this, what is the next major economic event and how will this affect it? Well, lucky for us, it's the FOMC meeting. This is where the Fed will decide by how many basis points they're going to raise the federal funds rate. Now, here's a super interesting turn of events. Yesterday, as of the time of this recording, which is a day before the CPI report came out, there was a 4% chance that the Fed would do a 100 basis point rate hike or higher. Everyone and their mother was expecting a 75 basis point rate hike. However, now that inflation is above 9% year over year, something that very few people expected, the market is now pricing in a 44% chance that the Fed is going to do a 100 basis point rate hike to try to curb this crazy price instability. Now, remember, this is going to be the last Fed meeting before September. Also, the GDP numbers will not have come out yet before this FOMC meeting. The GDP Q2 numbers come out July 28th, conveniently a day after the FOMC decides by how many basis points are going to raise the rates. So this is where the talks of a recession come in, because how can the Fed be raising rates so aggressively during a slowing down economy and still expect a soft landing? Raising rates by that much has a strong impact on the economy. For those that don't understand where the link is, I'll explain it to you in simple terms. When the Fed raises rates, that slows down consumer spending because everything is now more expensive, especially things that require financing, such as cars and houses. Raising rates also devalues the future earnings of corporations because now their future money is worth less than it is today. Raising rates also stops new business growth because now it is way more expensive to borrow money, so less businesses are started, and businesses that already exist are less likely to spend on expansion. Raising rates also affects the yields of fixed income assets such as treasuries, CDs, money market accounts, savings, etc. So people are now going to be more inclined or incentivized to save rather than spend. So all of this is an attempt to remove liquidity from the economy so that people stop spending and prices hopefully have a chance to come down. However, doing that too aggressively in a slowing down economy, there's almost no chance that the Fed can stop a recession from happening. In my view, the most they can hope for is a shallow recession, meaning one that doesn't last a long time or isn't too deep. So from here until the next FOMC meeting, we are likely to see a very volatile market. You will definitely see up and down days. However, the general trend is still down. And I don't think that is likely to stop until we get an answer to two major questions. By how many basis points will the Fed raise? And will the GDP Q2 come in negative? However, in my view, if we do get an official recession reading from an investment standpoint, that is actually the easiest time to buy. I mentioned this in a couple of videos ago, but if you look at the RBI, which is the recession buy indicator, you will see that every single recession, if you bought, your chances of making life-changing money are the highest than at any other point. This obviously assumes that you have a somewhat longer term horizon and you're not looking to retire in the next year or two. Also throw in the fact that the market tends to bottom out an average of 4 months before an actual recession ends, and the fact that your gains during a recession are almost 50% 12 months later versus 29% without a recession. This is after combing over data of the last 11 bear markets since right after World War II. Now, there is a scenario for a relief rally here. So if the Fed comes in at 75 basis points, well, that's not as aggressive as they could be, especially if the market is pricing in a 44% chance of 100 basis points. And then if the GDP comes out miraculously positive, as we saw with the UK today, the revised GDP actually rose by 0.5%, thereby booming the UK pound. If we see some sort of surprise GDP number that ends up positive for Q2 and doesn't throw us into a recession just yet, there could be a relief rally in the market. In my view, if you were thinking of buying here, this is actually a perfect opportunity to sell cash secured puts and name your own price on stocks and indexes that you want to own in the future. So here's an example of a few cash secure puts that I have open that I sent out in the Traveling Trader Academy a few months ago. I have a 135 cash secure put on Apple that I sold for almost $1,000. That would net me Apple at around 125 bucks if I get assigned these shares. If Apple doesn't fall below 135 by expiration, I get to keep the $1,000 that I sold these puts for. I have the 215 put on Microsoft. If Microsoft doesn't fall below 215, then I get assigned Microsoft at around $205. I have a 250 put on the QQQs, which if I get assigned, I will be forced to buy 100 shares of the triple Qs at 240 bucks. Currently, it's trading at 286. And Tesla, I have a 400 ridiculous cash secure put on Tesla that I sold for $2,400. Tesla's currently trading at $717. I'm up 50% on this. I can close it out now, or I can wait till expiration, keep all the money if Tesla's not below 400, or get assigned 100 shares of Tesla at 375. So if you have the capital, cash secure puts are actually one of the most valuable tools in a bear market because you get to name your own price and get paid every single day that the option loses value. You want access to all of the courses, current and future, including the options course, including the day trading course, which just launched today. Sign up, link is in the description. Talk to one of our ambassadors. They will help you get set up with applying to the Traveling Trader Academy. Let me know in the comment section what you think the chances of a recession are, what you think of the CPI report. Is it negative? Do you find more positive in it? I love hearing from you guys. Hit that thumbs up if you got anything out of this video. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.